everything. Gus is here. He's slowly coming on. And so I do the pitch. I come on every Monday, and I always tell like anybody that decides to invest with me, like you should, if you want an update on you know, what's going on or whatever, or what we're doing in the fund, then you could always just hop on the Mondays. And this is where I'm just, anybody that wants to listen, anybody that wants to listen can hop on anytime. Let me just let my dog out real fast, otherwise he'll be whining the whole time. Oh, ouch. Okay, good. All right, Gus is here as well too. Nice to meet you, Gus. I appreciate you hopping on. Last week I did like a whole bunch of calls with everybody too. So if everybody's interested in the fund, so after this pitch, if like afterwards you feel like you're kind of still have some more questions or anything like that, just let me know. And we can always hop on a Zoom call as well too. I've opened up my Tuesdays to be able to do calls for all my you know, prospect investors, and then we can just chat about like how the whole thing works. So okay, good. All right, well, while we're waiting, let me just get started, and I'll just introduce myself. And I don't know if anybody, if you guys have heard of me before, but my husband is Pete. He's been investing in, we've been investing in self-storage for 5 years. Before that, we were rehabbing homes. We were one of those like crazy people that we did a lot of rehabs at one time. And yeah, at a time. So we were one of these ones that did like, you know, 10 to 15 rehabs at a time. And then what happened was in 2015, I got pregnant. And once I got pregnant, and then I told my husband we're not going to do any rehabs anymore. And I also told my realtor that we're not going to do any rehabs anymore. I told my investors we aren't going to do any rehabs anymore. The investors basically said, and I was 100% privately funded up through that. So we did like almost $20 million in rehabs in like 5 years. So I did a lot of rehabs. And all my investors basically were like, okay, now wait, what am I supposed to do with all my money now? What are we going to do? You know, and I said, don't worry, I'll find something to invest in. I don't know what it's going to be, but I'll find something to invest in. And so I started getting out. I started getting out there and looking for facilities. I mean, I started getting out there and looking for properties. I did not know. Like what type of property I was going to invest in, but all I knew is that I just had to figure out what I was going to do after I was going to do rehabbing. And so what I did is I told my realtor, I was like, I'm no longer going to be investing in rehabbing. I'm not going to do any rehabs anymore. And he was just like, what? I just bought a brand new car. And so I said, don't worry, we're going to get out. We're going to figure out something. I was like, I just don't want to do rehab anymore. I couldn't imagine myself like doing like 10 rehabs at a time and then have this like little tiny baby. So what I did was I got together with my realtor, and then he started bringing me all these types of deals. And he brought me like multifamily deals. And this is back in the day when like nobody wanted to do multifamily. All right. This is 2015. When like multifamily was like kind of just coming out of its like cocoon, and like not a lot of people were investing in multifamily, and it had like a bad, like, I don't know if anybody remembers this, if you guys are back in the day investing or anything, but and so, but then when I went to go look at all these multifamily properties, they all needed like huge big rehabs and stuff. So I just really was not in the mood to like do any more rehabs, especially like being pregnant and stuff. So I just basically told my realtor, I'm not in the mood to do rehabs. You have to find me something that does not need me a rehab. And then also we looked at like buying portfolios of houses. And you know, he brought me like a whole bunch of portfolios, and I was like, okay. But I looked at them, but in my mind I was just thinking like, I'm so tired of houses. I really don't feel like doing anything with houses anymore. And because I had just done so many rehabs, you know, and I was just like so tired of it. So so then he kept looking, and he said, okay, I think I found something for you, Stacy. And I said, okay, what is it? He said, I found the storage facility, and it's like 20 minutes away from your house. He's like, what do you think about storage? And I was like, storage? Oh yeah, that sounds kind of like something I could do, you know, especially with this baby. It's like passive income and I could take care of the baby and stuff. So I went over and I drove over to the storage facility, and it was just like this dumpy storage facility. And it had like all these tires everywhere and stuff. And I was like, you know what? I could totally relate to this thing. I could totally, because I'm not scared of dumpy at all. You know, I just want to just have something that's more passive. So that's when we decided to put an offer in this thing. We met the owner, we put an offer in, and he accepted the offer. And then from there, it's been storage facilities ever since. So that's all we've been focusing on. So my husband and I, we own 11 storage facilities under the brand Miscellaneous Self Storage, and they're all in Georgia and Florida. Now we've broken into the Florida market, and we're looking, and now we're kind of open for Miscellaneous Self Storage and for the fund. We're open to like anywhere in the Southeast, all the way along like the 10 or the 20, all the way into Texas, right? And which is really good areas to be in right now. And internally, the way that our business looks, my husband manages all of our, like, he's the one that manages our team that manages all of our storage facilities. And I'm the one that manages the team that does all the acquisitions. So we have, like, we break our company into what we call find them, fund them, run them. And on the find them part, we have an acquisitions team that like gets out there and just like calls owners and talks to owners, and you know, whatever areas that I'm interested in, they just call and talk to all the owners. And the truth is that we really have no issues with finding properties. And I'm going to go over the deal. We just got a property under contract, which I think is perfect for this fund. And we just got it under contract this last week. So I'm going to go over that a little bit today and show y'all kind of what we look for. We focus primarily on mismanaged facilities. And I'm going to just mute everybody just in case, so we don't, hear any back noises or anything. But yeah, so we focus on primarily mismanaged facilities. And up until now, they've been like they've been properties that are $1 million or less. But what's happened is that over the course of the last couple of years that we've been investing in self-storage, and we got into self-storage at a really good time. That was 5 years ago. So it was a really, really good time. And so I'm very blessed to be in this industry right now, because it is such a hot industry to be in. But we've been focusing up till now $1 million or less. And primarily those facilities are around 100 units, or like typically around 100 units or less. Okay. What's happened is that as we've been doing this over the last couple of years, we've noticed that there's this kind of like gap in the investor market, in the storage investing market. So a lot of people focus on like smaller facilities, and this is because, like, you know, this is like in their mind, they think like this is all I can afford. So this is what I'm focusing on. All right. And then you have like these kind of newbies that are trying to get into the market and buy their very first facility, and it's like a smaller facility, right? And then on the other hand, you hear like, oh, you should never ever invest in a facility that's like 30,000 square feet or less. Right. And like, I'm only going for the big guns, and I'm like $3 million plus. And I know a lot of people that are just like $3 million or plus. You know, this is basically, you know, what I'm focusing on. Right now, what's happened is that there's this kind of like, I call it the sweet spot, which is facilities that are between like $1 million and $3 million. And so if you find like an income producing property that is like, you know, $1 million or $2 or $3 million, you could most likely go to a bank and get a loan for the fund, right? I mean, get a loan for the facility. But what happens is that you come across these like mismanaged facilities. And these are facilities that could be anywhere from like 25 to 75% full. right? Now, also a mismanaged facility could also be a facility that has not raised the rates in like a really long time. And we come across these properties all the time. In fact, the property I'm going to show you today that we got under contract is something like this as well too. So a mismanaged facility to me is a facility that it's anywhere between $1 million and $3 million. And we can hopefully minimum 1x or higher the facility. And we do that by either just what I call ripping the Band-Aid and like increasing the rents. Okay. Or and then within like the first couple of months or so, we're making money on the facility. Or if it's a mismanaged facility, essentially we're going to stabilize that property. So we have a couple of different properties that we're looking at right now. One of them is like in the North Georgia area, and then so the North Georgia mountains. And it's a property that we're negotiating with the owners right now. He wants $1 million for this property. It actually it's three separate facilities that are kind of right next to each other, about not even a mile away from each other. And it's 220 units. Okay. And he wants $1 million for the property, but it's only 25% full. Okay. And so that property, once we get it full, is worth minimum $2.5 million once we get it full. In fact, North Georgia properties right now, I was talking to a realtor just like maybe a couple of weeks ago, and he was saying that they're selling it like a 4 cap right now. We're buying this thing at like an 8 cap because we typically run our numbers anywhere from a 6 to an 8 cap, something like that. Okay. For mismanaged facilities. But anyway, so he's going to sell us that property at 25% full, and it's going to take us a good like year and a half, 2 years maybe to get that thing completely cleaned up, leased up, full, and then turning a profit. So it's going to take us some time to be able to produce a tax return that like, a good, at least one tax return, if not 2 tax returns that show a profit. Right? Because it just takes time to lease up facilities. It just takes that time. And so the thing is that it's very difficult to fund these types of processes. There's no bank that's going to fund this deal, right? So these are the types of deals that I don't want to pass up. And so in my mind, this is what I call like the sweet spot are these facilities that we come across where like the physical occupancy and the economic occupancy are like super low. And basically the owners are just like not into it anymore. And in fact, this is exactly how this owner is. He actually owns a facility like about 2 hours away. He manages that facility and that facility is doing great, but he doesn't want to drive 2 hours away to manage this one. In his mind, he doesn't even have a website for his facility. He doesn't go online for his facility. So in his mind, he can't really manage that facility like long distance, even if it's just a couple hours away. All right. So that's like one of the types of facilities that we're going to buy. All right. And the other type of facility that we're going to be buying is are there income producing properties where the owners have not increased the rates in like years, right? And so the one that we got under contract right now is exactly that way. And a lot of owners, what I've noticed, and especially in secondary markets, because this facility that we have is under contract in a secondary market, is that the owners just don't the owners have not increased the rates since before COVID, and they don't want to increase the rates because they're like, too scared to and stuff like this. Or they're just nice people, because the truth is like most storage facility owners are just like nice people, and they get taken advantage of a lot. All right. So this is exactly how this owner is. So we picked this facility up, and I'll show you it in just a minute, but it's running at 73 cents a square foot. And we did extensive research on like all of the competition in the area. And it's in a market that's like a secondary market, and the competition is like CubeSmart, U-Haul, Public Storage, Extra State Space Storage, but there's also a few like mom and pop shops. And so basically what we did is we took out all the competition of like all the like the bigger players, because we don't really consider them competition anyways, especially if it's like not the same size that like the same kind of facility that we have. And I'll show you a picture of what this facility looks like. But that like this was like we took all that competition away, and we just looked at like mom and pop facilities just like ours. And like everybody in the area, all like the bigger players are charging more than $1.20 a square foot. Our facilities, like our mom and pop competition, is at like $1.20 a square foot, and he's charging 73 cents a square foot. So we'll be able to, like, as soon as we buy this facility, we'll be able to, what I call, rip the Band-Aid. And then in the first quarter that we buy the facility, we'll give the tenants a 60-day notice. We'll let them know that we're increasing the rates up to market value. And if they want to leave, they can leave, you know, and then we'll have to stabilize the property and make sure everybody that leaves, you know, everybody that leaves, and that we get new tenants in. And that's going to take probably like, you know, a year to 18 months. But I'm guessing for this type of a property, we'll only be holding on to this facility for maybe one tax return. 18 months later, we could sell that property. Right now, I'll get into like the deals of the facility here in just a minute. But essentially, I just wanted to give you kind of an overview of like what's happening in the market and what it looks like. Getting out there and finding, like, we get out there and we find like severely mismanaged facilities, and it's very hard to fund these types of facilities. And then also, as we're scouring and looking for facilities, we come across these facilities that the rates have not been increased in like minimum 2 years or more. And the truth is like, I just talked to a storage facility. I just went to dinner with the storage facility owner here in Austin, Texas. That's where I'm at right now. And he has two facilities that he owns, and then one that he's buying right now. And he told me that he's increased the rates 9 times in the last year. 9 times in the last year. All right. And so the truth is like a lot of storage facility owners, they just don't do that because they're nice, and they don't want the people to leave, and they're scared they leave because then they're going to not make the money and this kind of thing. But the truth is that they're leaving a lot of money on the table by not increasing those rates. And so guess what? We get to pick those up, and then we get to make the money. That's what we're going to do. So I'll show you that one in just a few minutes. But yeah, so we go by find them, fund them, run them. All right. My job is funding. So I'm the one that sits here and pitches and talks to investors and raises the money, and I manage the fund. We have people that manage the fund, obviously fund manager, and like, you know, and then actually my CFO, Siri, he's going to help as well too, and the bookkeeper and all this kind of stuff. But yeah, so we'll have somebody that manages it, but essentially my job is to raise the money and talk to the investors and try to get you guys to commit and help us to grow the fund. And then we have our acquisitions manager that has worked with us for over a year now, and we picked up 6 properties last year, and he's really managing our acquisitions department, our acquisition side of the business. He's the one that works with the VAs to find all the facilities. Finding the facilities, we really honestly don't have any difficulty doing this. It's just time consuming. That's all it is. It's just repetitive, time consuming. And then on the run them part, so we have like my husband, and then he has his team. My husband's name is Pete. He has his team underneath him, and they manage all of our 11 facilities. And basically what we're doing is like the fund is going to have a property management company, and then our team is just going to help manage the fund and help manage the properties that are inside the fund. And so we're working on that and getting that all set up as well on the back end. So that'll be good. And our property management, like our internal property management team, knows how to manage facilities. So it's just a given that they'll just help us to manage the fund facilities as well. Okay. So if y'all have any questions, y'all can always unmute yourself and then ask the question as well too, while I'm just sitting here talking. But that's kind of the overview. Instead of me going like through a presentation and slides and stuff, I figured I would just give y'all a quick overview of it. And actually Rob is here too. So Rob, did you want to introduce yourself real fast and just say hi to anybody?
Sure.
Okay.
So my name is Rob Thomas. I have been working with Stacy and Pete for the last couple of months. in helping get the fund paperwork all ready to go. And as Stacy mentioned, we are. And so it's a great time to be working with them. I have a long history of finance and finance positions in the West and also in the Deep South. And so the opportunity to jump on board and work with Stacy and Pete was really a great opportunity, and not only just to do what I do, but to also learn about the fund and to learn all about investing in these properties. And so it's really a double blessing for me. So it's been a great experience so far, and know will continue to be so. So yeah, really happy to be part of this.
Okay, thanks. Okay, we'll get into the presentation unless somebody had a question they wanted to ask before I started. Okay, I wanted to show you guys just a couple of things here. I'm going to show you first this right here. Okay. Okay, so first, if we go to the website is self-storagefundofamerica.com. That's the website where you can go to. Once you come to the website, you're gonna have to fill out your profile. Okay, and I just wanted to show y'all kind of what it looks like. You'll come in and you'll fill your profile out, and then you'll get access to the portal. And this in the portal is where you can see the PPM. It's right here. And then you can see any documents that have been uploaded as well. Okay. And this is where we will talk to you throughout the whole process. We'll send you messages. We'll give you the reports, and then and this kind of thing. So make sure that if you have not already asked for access to the portal, then and just give us a little bit of time, because we do have to approve you and give you access to the portal. Okay. Once you come in, the portal is going to look like this. And you're going to be in the prospect, you'll be in the prospect area. And the prospect area is essentially where, like I said, you'll be able to read the PPM. Inside the PPM is the, let me see if I can view the PPM right here. And you can download it and you can read it that way as well too. But it does have it as kind of like an ebook. And then in the ebook is where you can go through page by page. There's like 100 pages here, obviously. So you got to read all this. But inside this PPM, it goes through what we're going to be doing, how it's structured. It shows all of the properties that I've invested in. It shows the operating agreement. It really kind of just shows everything, what you really need to know about everything. So that's there. I just want to make sure y'all knew about it. And then also on top of that is the any other documents. The investor presentation is here as well. Let me see if I can. Yeah, investor's presentation is right here. And then this is steps to invest. This is actually the process that Ariel made. She works with us as well too. And I wanted to show that to you as well. So let me see if I can find it. Just so that you guys knew how to find the step-by-step process. And this is really kind of just the step-by-step process. So you're going to you come to the pitch, right? You've already done that, get access to the portal, check out the PPM, check out all the information. If you need to set up a Zoom meeting, you'll set up a Zoom meeting with me if you want. I'm always open to talk to anybody, about it, about any questions that you have. You'll upgrade your account to investor in the portal. So once you're ready to say, okay, yes, I'm ready to invest, then you'll upgrade to this. I'll show you how to do that in just a minute. You'll make a commitment, and the minimum is $25,000 or more. You'll have to show proof of that you're an accredited investor, and I'll show you that here in just a minute. And you'll upload those docs, and you'll wire the money over, and then you'll get paid on quarterly distributions. And I'll go over the fund and all the numbers here and stuff in just a sec. But I just want to show you that is available. That's what that document is as well. And let me see back. Okay, let me go back to this. Once you come into the portal, then once you come back into the portal, let's get you back over here. So now you'll ask for an investor access. Okay. Once you get investor access, this is where you'll get the subscription. Okay. This is where, if you're investing as an individual, if you're investing as from your IRA or 401k or whatever it is, and this is if you're going to be investing from a company. All right, so there's 3 different documents here. You'll go through and read this. It's long as well, just so everybody knows. And it's a DocuSign, so you can sign that document right then and there. In this document is where you put your bank account information. In this document is where you're going to put, so it'll come up just like this. This is where you'll just sign all your information, the date, any information that's needed. Also, another thing is the wire information is in here. Yeah, this has me like sign in and stuff, so I'm not going to do that. But like essentially that document is going to show you like all the information that you need and like, put your bank account information and stuff like this. Is basically the contract between you and me. You're right, as investor, as the fund investor. Okay, and then this is where you're going to be uploading the accreditation letter, verifying that you're an investor, and here is the wiring instructions. And then after that, that's really done. So it seems kind of like it's a lengthy process, but it does take a little bit of work, and I get that, but you can always ask me if you have any questions. You can always ask me as well too. Okay, I wanted to show you that. That is basically the portal, just so you had kind of an idea. I also wanted to show you the presentation so that you guys had an idea of what we're looking for. So I already told you what type of facilities we're going to be looking for. These slides right here that are coming up, this is basically talking about like what kind of facilities we're going to be looking for. This is the offering characteristics. So we're trying to raise $7.875 million with an option to expand to $10 million if we want. The targeted IRR is 19%. The hold period is a 5-year hold, right, with two-year extensions. And so what that means is that whatever amount of money that you commit to will be held in the fund for the 5 years, and then but the distributions will be paid on a quarterly basis. So and depending on, so for instance, like this facility that we have under contract right now in Pensacola, this one will buy and will automatically be making money on it, right? Because it's already making 150 grand. It's already making 150 grand a year. So it's already making money. So we'll have some sort of a distribution on a quarterly basis. And then as we increase the rates within the first 60 days, we'll increase the rates. And then over the course of the next quarter, then we'll start making more money. And then your distribution will be increased because we'll be making more money on it. Okay. And then once we decide to sell, then everybody will get a distribution on that as well too. So basically the preferred rate of return is, the preferred rate of return is 10%. So what that means is so we're looking for a 10% rate of return. What we're going to do is we have this kind of like what is called a waterfall, which is the first hurdle is 80%, it's an 80-20 split. So 80% to investors and 20% promote. What that means is that up until 15% IRR, we will not, so my husband and I will not make any money, right? Where our promote is not until we hit the 15% IRR. Once we hit 15%, then we'll get a 20% promote, okay? And then after 15%, if we get over 15%, the second hurdle is a 75-25% split, okay? And so basically that's just an incentive for us to be able to be managing the property properly, right? And that's our goal, is to be able to get that up and running so we all can make money. And let me just go on to the next slide. It's right here. Okay.
Stacy, I have a question for you.
Yeah.
Is that quarterly, monthly, yearly? What's that percentage?
Quarterly. That's
okay.
Quarterly. Mm-hmm.
Thanks.
Yeah, it's quarterly distributions. And our contribution, so we will be putting 4% in as well too. So just so you know, we are putting some money into as well. And again, like I said, it's 20%. It's a 20% promote after we hit the 15, or up to 15%, after we hit 10, up to 15%, and then 25% thereafter. And then the minimum investment is $25,000. It's for accredited investors because it is Reg D, it's 5060 Reg D fund, okay? And so the split, the hurdle split, the tiers are, it's a 96-4, right? So we'll be putting in 4%, investors will be putting 90%, 96% in at the, and then once we hit 15%, we'll still have the 4 in, like the 4% in, and then we'll get the 20% promote, and investors will have 76%. And then at the 25, I'm sorry, at the over 15%, we'll be getting a 25% promote, and the investors will get 71%, but we'll still have 4% in. So no matter what, we'll put the 4% in, and we're going to get that 4% back. That's basically what it's showing here. And then as we go up the tiers, then we'll be able to make, Pete and myself, my husband and myself, will be able to make more money. Okay. And also another thing is we really tried to minimize the fees on this too, because we wanted to be competitive. This is our first fund. So we really tried to minimize all fees. So really we have a management fee, which is only 0.625% of the gross purchase price, right? And that's per year, right? So every year we get a 0.625%, which comes out to like $6,000 per $1 million, something like that, you know? So try to minimize the management fee. And then also the acquisitions fee is 0.50% of the gross purchase price as well too. And that's just a one-time fee. If we do develop, it's 5%. There's a 5% development fee and a 7.5% general contractor fee. Now, typically we do not develop. So, but just in case we find a facility that you know, has a lot of acreage on it, then maybe we consider, you know, putting more units on it so that we can, you know, make more money on the back end. All right, but we're more of like rip the band-aid and stabilize the property is what we are. But you know, you just never know what you're going to find. If it's such a great deal, then maybe we'll consider doing that. Okay, good. And I wanted to go over, that's really the offering. And this presentation here just goes more into depth than exactly what I talked about, right? All the different types of facilities. Here's facilities that we've owned, or these are prospect, you know, like prospects that we've been looking at. These are the types of facilities. And I wanted to show you also, yeah, let me see if I could find it. Pictures of this facility here. Yeah, and I just wanted to show y'all kind of what it looked like. This, okay, so this is the front end of like the facility that we're looking at right now. Can y'all see this picture? I think so. And this, it's like, it's your typical storage facility. It's gated, it's fenced, it's got you know, it's all you know, electronic, there's you know, electronic security system all set up. I mean, it's a really nice facility, your typical facility. This is right in the middle of like Pensacola, and I'll show you the numbers here in just a minute, but essentially this is what it looks like. And just like all of the previous facilities that we've ever bought, this looks exactly like all of them, right? So there's nothing different from these at all, these as well. But that, I wanted to show that to you so you could see it. And then I wanted to show you the numbers too, so y'all could kind of see this as well. So we picked this one up for $1.78 million. And we're buying it at a 5 cap, which is low. But the thing is that it's already making almost $160,000 a year. It's 164 units. It's 20,000 square feet. And it's pretty much like, you know, it's full is what it is. Okay. There's no work that needs to be done at all. There's no CapEx at all, nothing. Like, we're going to just buy this. It's going to be just running just the way that it is. The property taxes are most likely going to go up. But, all right. So once they go up, then we'll adjust the rating, but adjust the number. But essentially, the property taxes will go up. The utilities are about $4,000 because it is completely lit. It's nicely lit. It's a very nice, nice setup. The insurance is about $67.20. So you guys can see all the numbers right here. I'm just going straight down this row. So what's going to happen is, as soon as we buy that facility, we're going to increase the rates to $1.20. And which is exactly what I told y'all the competition is at. And we may be a little bit less, you know, but the truth is that like they're all full. Everybody's full. and in this area. And so there's really no place for them to even go. So they're going to just move out and be done, or they're going to, to try to go to someplace else, and we're all going to be right at the same price, so we're going to just rip that Band-Aid. There's no room to like grow. There's no room to add anything else on or anything like that. It's just a fenced in storage facility. And all we're going to do is just increase the rents to $1.20. So as you can see, it's at a 5 cap. It's valued at about $2 million at a 5 cap. And it's Pensacola. It's like, it's the middle of the city, Pensacola. So, I mean, is it a 5 cap? Is it a 6 cap? I don't know. I don't know what the cap rate is, right? But essentially we ran numbers at a 5 cap, and we're going to be increasing the rates and making it worth quite a bit of money. So let's just say we ran the numbers at a 6 cap, right? So I could see at a 6 cap, it's at 1.732. We ran the numbers actually at a 6 cap, at a 6 cap, and we just offered, this is what we offered. We offered 1.73. He came back at 1.78. He was under contract. He was listed at 1.9. All right, so he's come down like almost 150 grand for us too as well. But even if we increase the rates to $1.20, this facility is worth it's worth $3.4 million. So we're not only going to make money, we're not only going to increase it from $160,000 to $260,000 annually, we're also going to be making quite a bit of money on the back end when we sell. All right. So this property, I think, is a very, very good property for like a first property for the funds, right? I think it's like the perfect property because everybody that comes in to the fund will be able to make money immediately. It's not like a severely mismanaged facility, because severely mismanaged facilities could take like, 6 months to make money, or longer, even a year sometimes. So, yeah. So I think this will be a really good one because we'll be able to get in and start making money immediately, and then we'll be able to increase those rates and then stabilize it and sell it. Let's say like after we get our first tax return, maybe in 18 months, we'll be able to sell that property and all make some money on it. So I'm really super excited about it. Okay, good. All right. That is the presentation. So if y'all have any questions, I see a question in the chat, I'll answer. Y'all can unmute yourself as well too, but oh yeah, 2 1-year extensions. You said two. Oh yeah, sorry. Yeah, it's 2 1-year extensions. So it's a 5-year hold with 2 1-year extensions, 2 possible 1-year extensions. Okay, is what it is. Okay, good. All right, so good. Who has some questions? Anything that y'all can think of that I didn't cover? Thoughts? Can you unmute yourself and ask? I would love to hear.
Hey, Stacy, this is Rick. Can you hear me?
Oh yeah, I can hear you. Hey, Rick.
Hey, so this is actually a question for the other investors.
Mm-hmm.
Is anyone else looking at using a self-directed IRA to invest? And have they looked into that as far as the paperwork?
No, this is Steve now.
Okay. I went over it today, looked at and I can talk to you about this individually, Stacy. I kind of went over it to see what all is involved. And
did you go into the subscription and choose the one that said the custodian?
Yes, I think so. Yeah.
Okay. Yeah, that's the one that you should be looking at to go through and just fill that out. I don't really think it's any much different. But what did you see?
It looked rather complicated. So because of all the questions you had to answer, and it didn't really fit with a self-directed IRA. So I think like we talked about the other day, I think I will call Advanta tomorrow and look into them. But I thought I would throw it out there to see if anybody else had explored that yet. Okay.
I can talk to, I'll talk to the other investors that are investing already, that's committed already, and just see if any of them are going to do an IRA, because I know you have a self-directed IRA, so I'll just see if anybody else is doing that. And
Okay,
actually,
all right.
yeah, and I'll talk to, like, I use American IRA for ours. So, I'll just ask them, like, how complicated is it, to like invest in a fund through I know you can do it. I just don't know like what the rules are behind it.
Yeah. Okay. All right. Very good. Thank you.
Okay. Okay, good. Who else has some questions about the fund or anything? Who's mute? I think Marlon, are you Marlon?
Yeah,
Hey.
so, yeah, using the self-directed IRA really isn't hard. We've got people in our fund that do that. I was gonna ask you, so how much money are you looking to raise into this fund?
It's
You got like a
7.8, it's 7.875 million.
Okay. And so like if a person puts 100,000 in, you got a 5-year hold. You talked about maybe, flip a property in 2 or 3 years and you sell that property and then send a distribution back to the owners. But the main principal, initial, I should say, fund money would stay in the fund until all the properties are sold.
Yeah, until the fund is up. Yeah. So the fund, we could have everything sold within the 5 years, or we might extend it out 2 more years.
Right.
Yeah.
So are you wanting all the money in there? And when you go to buy properties, is the money just sitting there in the fund? How's that playing out?
No, good. Thank you for bringing that up because I didn't talk about that. But no, we're going to be doing closes for every facility that we buy. So we'll be
So
doing
then you do
like,
all the
yeah,
money?
yeah. So we'll be doing like calls to like a call to commit. So like right now, this fund right now is like a call. I'm sorry, it's this facility that I just showed you, $1.78 million. So now we're looking for commitments for that. And then what will happen is we'll let you know when we're gonna, once I get that money, then we'll close. Because it only take a couple weeks to, I have the property under contract for 90 days, but I told the owner that it could be sooner than that because essentially all I have to do is just raise the money. So really I'm looking for commitments, and then over, like, I would say within anywhere from 30 to 90 days, we'll be closing on that facility as soon as I can raise that money. And I think I have already about $1 million raised. So we could be closing on that sooner rather than later. I would say like within the next 30 days or so.
Okay. But this fund's designed to also buy other properties too.
Yes, we will be buying, like, I'm guesstimating 3, 4, 5 facilities in this fund, and we'll be doing a close for every single one. So the money that you have in the fund could go to, once we give you the distribution, it could go to another fund if we buy another property as well too. I mean, it could go another facility if we buy
Right.
another facility after we close on yours. So depending on how it kind of works out, how many deals we'll be able to buy.
So how do you factor out what percent each investor's money is going to be in that fund? Is it, you look at the total amount in there and then divide it out on percentages of their total coming in, kind of a
Yes.
deal?
Yes,
Okay.
exactly. Yeah. So whatever amount that you put, if it's 25,000 or 100,000, then you'll get that percentage of that deal of whatever we've put in from everybody.
Yeah, okay.
Yeah. Okay, good questions. Unless Rob, you have something else to say about that.
You got a nice setup, I will tell you that.
Okay, good. What do you mean by setup?
Well, I mean, the 80/20 and 10% prep and all that kind of stuff. I mean, those
Okay.
are nice numbers.
That's what I said. We tried to, I hired a consultant to help me put this thing together. And we looked at all the funds out there right now, and we tried to be more competitive than all them. Right. So, and this is our first fund, honestly. So we're just we want to show you guys that, we know what we're doing. And like I said, I've done $20 million in transactions in the last 10 years. So I know how to raise money. We know how to manage properties and stuff like this. It's just, this is a fun. So it's a whole new thing for us that we're trying to do. So I wanted to make it as competitive as possible.
Yeah. No, I think you're doing a great job.
Thank you. I appreciate that. Did you have something to say, Rob?
So the only thing I'd add is, some other funds may collect all of the money for the total. So, we could try to raise the entire 7.8 up front and then go out and start purchasing properties. But in order to make it more manageable for everybody, and what we decided to do was, so just like Stacy said, with this first property, I mean, originally we could close the fund after we raised, I think it's $500,000. But what we'll do with this, since this property is in play and we get commitments to invest, then those will all align. So it would, if you can almost think of it in terms of a capital call, right? So the commit will be there. We will let everybody know when and where to wire, well, the where to wire the money, already but the date to wire the funds so that we can go ahead and complete the transaction. But that way, it's much more manageable. All the IRR calculations, everything else are more in line based with the purchase of the property instead of having cash just sitting there. And so it seems to be the best way for us to progress through this.
Yeah.
I
Stacey,
agree with that.
I have a question here. So how do you plan on communicating with your investors? Will it be on a monthly, quarterly meeting, newsletter? How do you plan on just communicating?
Well, we have the portal. Honestly, the truth is I do a lot of communicating. All right. So we have the portal. So we'll definitely have the reports, the quarterly reports, and then the annual reports in the portal. But the truth is like every Monday I'm going to be doing this thing. So I can give, I'll give updates on how the fund is going. This is not really like, this is like me trying to find more investors, but it's going to be a progressive webinar. Progressive meeting of me going over what's happening in the fund. And then also on top of that, anytime that you want to meet with me at all, like I am the type of person, I open up my whole Tuesday for any investors interested in talking to me about the fund, asking questions, how it's doing, then I'll just hop on a call with you and then we'll just go over everything too. So, I'm not the type of person to not communicate, but definitely for the reports, it'll be quarterly and then annually and then quarterly, right, Rob?
Yeah, but at all times, like Stacy said, the portal itself will have all of your information per investor, right? So you'll be able to go in and look at any and all activity associated with your account.
Yeah.
Got it. And I believe you mentioned this, but I may have missed it. But so when do you anticipate having a return on investment?
Well, that's what I said, this first deal, you should definitely like within the first quarter. It just depends on, because it's already making money right now. It's making $150,000. I mean, the NOI on this facility is like, if we don't have a mortgage on this facility, the NOI is like $100,000 a year, so we'll be making money in the first quarter. Right. And then increasing the rates in the first quarter will give us even more money in the second quarter, because we'll go, we'll go from 73 cents to $1.20, $1.15 immediately. So you'll get that in the second quarter. And then after that, you won't we'll have those rates, but we probably won't be raising them as, every 6 months you raise the rates or something like this. So, so you'll see a little bit more every,
when you say making money, what percentage are we speaking about?
Well, I mean, as I said, the targeted IRR is 10%, so just think about that. I mean, and then hopefully we can hit the 15, the 15 to the, to 19% IRR, which I'm guesstimating, so really the net of $260,000, $250,000.
So you're projecting what, 10% on a quarterly basis on your investment?
Yes.
Okay.
So the preferred rate of return is 10%.
Got it. Thank you.
Okay, good.
Hey, Stacy, this is Gus. My question, I might have missed it, but let's say we put in an initial investment, and then later on, if we wanted to have an opportunity to invest more, is it something that you'll have a capital call opportunity to do that for the same fund, or will we have to wait for another fund to have that opportunity?
No, we'll be doing capital calls for every deal that we have. So
Okay,
you
so
could,
for every
yeah,
deal.
yeah, for every deal. So you can put 20, put 25 or $50,000 in now, whatever one you put, and then the next deal, you could also put some money into that deal as well too.
And then the principal would remain in the fund for the 5 years or until you close the fund.
Exactly, yes.
Okay, thank you.
Good. Cool, awesome. What else? Good questions. Okay. Well, again, like I said, I'm here every Monday night, or if you're interested, you're more than welcome to hop on a call. You'll get an email from Ariel just, with all of our information on it. You can hop on a Zoom call with me just one-on-one, and we can discuss like, what you're thinking and like any questions that you have as well. Okay.
Will you be able to send us the deck so we can actually dive into the numbers ourselves?
Yes. So you mean like the deck for are you talking about the investors presentation, or what were you talking about? The model or what?
Well, I guess what because you gave an example. I'm assuming that's the one that you're actually planning on moving forward with,
Yes.
right?
Yes.
Yeah, I'd like to kind of just review your expenses, your debt, and like just overall how the business is actually.
What
Operating.
I'll do, yeah, I'll save that, my deal analyzer, I'll save it into the portal.
Yeah.
And then you can get in there and take a look at it. Okay. I'll try to
Thanks.
figure out how to save it so you can get an interest, because actually there's a lot of tabs on there and stuff. So let me figure out how I can make it into like a nice book for you, and then you can get and look at the numbers. Okay. Yeah. And I can always, and if anything, I can always jump on a call too, if you want to ask me about expenses and stuff like that, but you'll be able to see the expenses. In fact, let me just share the screen real fast. It looks like this. So here's our expenses. Here's our expenses right here. So when you look at this, you'll be able to see, because like here, that's 26. This is going to cost us $26,700. This is the formula right here. So you'll have to essentially look at our formulas in order to see kind of how we came up with all of our numbers and stuff, if that makes sense. But like, yeah, this is our typical. Now take this out, because this mortgage, because yeah, we're not going to have a mortgage. If we can raise the money, we won't have a mortgage on this thing. Now, another thing with this deal is I could actually get a mortgage. What's better? I mean, because this one is an income producing property, so I could just get put 20% down or 25% down, and then just go get a loan on this one, so we're looking at that as well too. What's better, to just pay cash and then everybody get the distribution from that, or to actually get a loan on this one?
Well, it would depend, I think, based on what your actual end game plan is, to actually flip it in, the 3 to 5 years, or if you on having it a long-term hold, right? That will depend on your interest and etc. So.
Yeah, I would think, typically I would think like selling this property and making $1 million+ on it would be, something that I'd be more interested in. What do you think, Rob? You can say something. I saw you unmute yourself.
Yeah, so one thing I was going to add was this can be a little unique to this property, just because I know some of the other properties that Stacy and Pete have talked about. One example, it's profitable. The gentleman has never kept any books, so everything is all on a cash basis transaction. So, the ability to go to a bank without any financial statements and get any kind of financing would be really difficult. Maybe going to a hard money lender, could potentially be an option, but even that could be pretty tough with no financials at all. So in some situations like that, where we don't have the ability to go to a bank, we may run it for 6 months or a year, get the financials in shape, and then be in a position, based on the needs of the fund, the amount of money in the fund. We want to free up more of that money to go out and buy other properties, to be able to finance that at that point, is always an option. But some of these distressed, fixer-uppers, if you will, it could be a challenge to be able to get conventional financing that way. So that's one of the purposes of the fund, is to be able to have the cash on hand to be able to go and buy those properties. and then work towards financing if that's something that's in the best interest of the fund.
Yeah, I agree.
Yeah. Yes. That we're talking about that, but the truth is like you just never know what kind of deal you're going to come across. So that's the hard, like we find so many good deals, but then like when are they going to close? How long are they going to close? And there's just so many factors and stuff. So it's like,
Here's an off question for you.
Yeah.
Can you share a little insight on maybe on a past experience investment that maybe didn't go as planned and how you managed through that?
I mean, the truth is, let me think. I mean, because we buy like up until now, we've bought like just small facilities. So like, I would think really the hardest part about buying a small facility is being able to manage them. Right. Because like, you do as much work with the management of like a smaller facility that you do with like a bigger facility. It's just a different type of management. But the thing is that with these smaller facilities, I mean, we really like, we'll buy something for like, $300,000-$400,000 and it's worth, I mean, now we have stuff that's worth like, $1.5 million. So we're really tripling the value of those properties, but it's just a lot more hands-on work. So we're used to that. So I would say really the ones that have not gone well are the ones that are severely, really mismanaged facilities. And the only reason that they've gone not well is because they require a lot more hands-on work to get them up running and like making money, right? But all the properties that we have, they're all full and doing well, right now.
Do you focus on class A or B or C facilities?
Oh, we focus primarily on class C facilities is what we focus on.
Okay.
Yeah. Yeah, that's a real mismanaged facility typically. Now this one here, the one that I just showed y'all, what would you consider this? A B? A C to a B, I guess, I mean, it's making money. It's just not making what it should be making. What's that? And it's in Pensacola. What would that be considered?
I don't know. Your class A's are like what, 2000 or newer builds in ideal neighborhoods. Class B's are like 80s, 90s mom and pop shops, right? And then C is like older ones that require a lot of maintenance.
Well, no, because I found like class B's that are like severely mismanaged, So,
yeah. I mean, overall, it's like
I mean, typically we're buying like class B. I mean, if you want to go by age, they're all class B facilities. But we can find like the one that we're buying up in the North Georgia mountains. That's the 220 units. I mean, that's a class. I guess that would be a class. That's a class C. That's a class C because it has the brick. Has like the brick. Some of them have the brick foundation, like the cement block foundation and the cement block walls and stuff. So I would consider that maybe a class C.
Where in Georgia? I have real estate in Georgia, so I'm just kind of curious.
We're all over Georgia. We're everywhere, all over. We're north, south, middle, everywhere. You can just search Miss Lillian's Storage. And then we're also in the Panhandle of Florida. Now, the facilities that we buy in the fund will not go under Miss Lillian Self-Storage. The facilities under the fund will go under the fund. They'll all be separate companies underneath the funds. But all of our Miss Lillian stuff is all in all over Georgia, from north to south and in the Panhandle of Florida. Okay. Yeah. Okay, good. Well, I really, really appreciate y'all hopping on, asking questions and stuff, and just let me know if y'all have any other questions. Okay. And
great. Thank you very much for your time.
okay, take care, everybody.
Thank you.
Bye.